partners in it can be of two types: limited partners or general partners. General partners are the ones that are involved in the day-to-day running of the business, and the limited partners are the ones that are just really their contribution is the money that I've infused into the business. And what this goes to say automatically is that, first of all, profit sharing, the higher one goes to the general partners, and then when it comes to liability, general partners have unlimited liability. It also goes without saying that limited partners have limited liability because all they have to lose is their investment in the business. Now, the last one of this is the corporation, which is the higher one, and it's a legal entity in which the separate owners are different from its operators. It's formed by filing articles of incorporation with a regulatory body in an organization. Here, the owners of the business, who are the shareholders, and then their managers. The owners of the business choose managers to take care of the business for them. Because of a conflict of interest, they also elect board members to oversee the operations of the managers and ensure that their interests are aligned. Corporations can be profit or non-for-profit, and they can be private or public. A public corporation might be defined as one that has shares or at least has a minimum number of owners. And that brings us, in summary, to the end of that reading. Pardon me, there's one more to go. I almost forgot that. There are ways in which a company can become public. The most popular one is by an IPO, or when it's being acquired by a private company. And then there are also ways in which private companies can become public. Number one is by a leveraged buyout, where a group of people come together, take some sort of facility and buy out the company, or by a management buyout, when the organization staff, the senior management, come together, buy out the company. In most cases, they operate it for some time, and then after some time, exited by IPO or what have you. Now, when it comes to disclosure requirements, public companies have a lot more requirements from the regulators. They're supposed to file their results, most times quarterly. And then in terms of private companies, are not subject to those requirements. When it comes to claims of the organization, the interests of lenders have higher priority. Now, it is quite tricky. Lenders have higher priority, but they have limited upside potential, because at the end of the day, if you lend me money in my business, all I owe you is your interest and your principal. No matter how well the business does, you don't get anything more. But the owners of the business on the other side have lower priority, but they have unlimited claims in terms of profits, depending on how the business goes. So what this means is that sometimes there's some sort of conflict of interest, because the lenders are interested in getting their own funds, that's payment back, while the owners of business are interested in the business growing, and they might be tempted to take a lot more risk in terms of leverage so that they can build the organization and earn a lot more. But that puts the lenders at risk, because it might affect the rate at which the organization is able to pay back their debt. So that brings us to the end of that. I'll give 2-3 minutes questions, and then we'll go to capital investment. You can drop it in the chat box, or you can unmute yourself. Just to confirm, Mr. Yemi, Gloria, are the participants allowed to mute, or is it just to chat in the chat box? If there are no questions, I'm happy to go ahead. Any questions? Going? Okay. Just when I was about to go, none for me. Thank you, Homer. So I'm moving on to capital investments. Now, capital investments are investments that involve some sort of cash outlay at the beginning, and then inflows towards the life of a project. Now, the different types of capital investments can be broadly categorized into two: business maintenance investments and business growth investments. So business maintenance are ones where you have to do it for growing concern, or because government has mandated you to do so. So they can be seen as growing concern projects or regulatory projects. Now, business growth projects are the ones where the company wants to expand its growth, wants to improve its earnings, or just wants to expand generally. What this means is that expansion projects usually involve a lot more complex analysis and estimations. So imagine that at the beginning of the business of the project, you're sure of your outlay, but you now have to estimate what the inflows will be over a period of time. Most times it's over a year, And those analyses are what's going to determine whether you should go ahead or do the business or not. So it's a lot more complex, and it determines the overall profitability of the organization. Now, there's something called the capital allocation process. Because most organizations do not have unlimited funds, they have to now pick the projects that are most profitable based on what? A few things that they look at. Number one will be NPV, and the other one will be IRR, or how it fits into their structure or their style. In doing that, there are 4 steps to look at. Number one is generating the ideas. Number 2 is analyzing the project proposals. Number 3 is creating the firm's capital-wide budget. And number 4 is monitoring these decisions to ensure that what you have achieved or what has happened is in line with what you plan to achieve at the beginning. Now, there are 3 principles of capital allocation. And number 1 is that decisions are based on incremental cash flow. When you're trying to make a decision about an investment, sometimes some costs are going to be expended that will not determine whether or not you're going to take the business into the next step or the next level. Those costs are called sunk costs, and they should not be involved when analyzing the profit or profitability of the business. For example, I want to go into clothes manufacturing. I'm going to do a survey to see how many people in Nigeria already are even producing dresses for the office. How many markets in Nigeria can I get my materials from? Am I going to get them from outside Nigeria? All of those things, I am going to do it to even decide whether I want to go into the business or not. Whether or not I go into the business, those things or those costs I have expended. Now, when I'm doing the profits in terms of inflows and outflows, I shouldn't include them. But there are some other things that I should include. For example, if I'm going to start producing dresses, and before now, what I had done was trousers and maybe tops, I have to now consider that the sale of the dresses that I'm going to be producing now, how is it going to affect the sale of the trousers and the tops that I've produced in the past? That is called cannibalization. What that means is that I can't just say, oh, I've started selling 100 dresses. If I'm selling 100 dresses and I used to sell 100 trousers and they're now 50, I have to take out what I have lost in sales in those trousers and analyze it in putting together whether or not I should go into the production of dresses. Another one is externalities, and sometimes those are positive externalities. And positive externalities are things that affect other aspects of my business in a positive way. For example, if I used to produce something along the airlines, I was producing shampoo before, and then I started to produce conditioner. My production of conditioners might make my shampoo line sell more. In analyzing the profitability of my project of shampoo, I need to consider that, okay, it's going to have a positive effect on my conditioner or vice versa. And all of this can be or should be put into consideration when calculating the NPV or deciding on taking a project or not. Now, when it comes to cash flow, like we all know, time value of money, the time value of my time, but the timing of my cash flow is important. My 500,000 that I received today is worth more than 500,000 that I received 2 years from now. So in analyzing my cash flows and capital investments, the timing of those cash flows are important to me, and it might be a deciding factor in going into making a decision about that investment or not. Another thing is that cash flow should be analyzed on after-tax basis. And that is because taxes are going to be taken away from me regardless. So in deciding whether or not to go into a capital investment, I should consider what my cost or my cash flow will be after taxes have been taken away, not just looking at the cash flow before taxes, because that's the only thing that makes the most sense. Now, when we're talking about capital investments, there are conventional cash flow patterns and there are unconventional ones. Conventional ones are the ones in which the sign of cash flow changes once. Like I said before, you have an outflow at the beginning and you have a series of inflows throughout the life of the project. That's a conventional pattern, and that's one that is quite easy to calculate with your financial calculator. But at times, they also have unconventional cash flows where the timing changes more than once, or the cash flows are not linear like we'll have where you have a cash outflow in year 0, inflow in year 1, inflow in year 2. Sometimes you might have an outflow in year 0, not have any inflow until year 3, have another outflow in year 4. All of those are still seen as unconventional cash flows. Now, when it comes to making a decision about a project, 2 things that we use are your NPV and your IRR. One of the things that the NPV does is it calculates the present value of all your cash outflows, no, of all your cash flows. Your cash flows are your cash outflows and your cash inflows. And for a normal project, the present value of all the expected cash flows is what we call your NPV. At the end of the life of the project, if a project has a positive NPV, it means it is directly affecting shareholder value. So you want to accept all projects that have a positive NPV. On your calculator, the strokes are there. Clear your work, and then you start with cash flow. You put in the figure for what your cash flow is. You press the down button twice. It gives you an option to impute your cash flows according to the years that they come and the frequency. The CO1 on your calculator refers to cash flows, and the FO1 refers to frequency, and you keep going down once you've entered all of your inputs. And then at the end of the day, you press NPV, you compute, and you see what your NPV value is. Common mistakes that people make at this point is that they don't remember to put the minus sign in front of the cash outflow. If you don't do that, the value for your NPV will be wrong, and it will lead you to choose on a wrong option in an exam. Because of time, we're not able to look at an example of an NPV calculation, but on your calculator, the strokes are quite there. Calculating NPV is very straightforward. The biggest advantage of using an NPV as a measure in choosing a project is that it directly affects shareholder value. And we know that most businesses are in business for what? To maximize shareholder value. So you can say that because it's a direct measure on how it affects shareholder value, NPV is a good one to use. The major weakness with it is that it does not consider the size of a project. For example, a project that I'm going to invest 100 million in, if it gives me 100 naira as my NPV, the decision rule is to take it. A project that I'm going to spend 1,000 naira on, if it gives me 100 naira as my NPV, the decision rule is also to take it. So it doesn't really take into consideration the size when giving you an investment decision. Now, let's turn to an internal rate of return. When we talked about the NPV, we talked about cash outflow at the beginning and inflows at the end. The internal rate of return is that rate of return in which you discount your inflows by and makes your NPV zero. In other words, it is a rate of return that makes the two parts of your equation here equal to zero. That means, equal to each other. That means the CFO is exactly equal to the inflows. Now, a lot of candidates find this confusing, that why will you want an interest rate that just gives you the same value as your cash outflow? The deciding factor, or let me say what makes the difference here, is that it is discounting those cash flows back. And what you're using to discount them is a firm's cost of capital, which means that you are at least able to pay back the cost of investing in that project. So what that means is that it helps you at least break even. And the decision rule for IRR is that if it is greater than the project's cost of capital, then you should take it, and vice versa. Now, it has a key advantage, which is the disadvantage that NPV has, and that is the fact that it takes into consideration the size. The IRR is calculated in percentages. For example, if my IRR is 19, my cost of capital is 9, for example, it means that I'm getting 10% higher than my cost of capital as return. And what this means is that, for example, there's a minimum rate, which we call the hurdle rate, that I must cross for me to determine whether using the IRR, to determine whether to take the project or not. And this means that the minimum IRR that a firm requires internally for a project to be accepted is that hurdle rate. Now, the key disadvantage of the IRR is that, like I said, it is the interest rate that equates the two parts of the equation. So sometimes there can be more than one interest rate that takes care of that. Secondly, it assumes that the cash flows are invested, that cash flows are reinvested at the IRR. But the NPV assumes that the cash flows are invested at project's required rate of return. Now, there are costs of capital for the organization, and sometimes it is applicable to use for a project, but sometimes they are not applicable depending on the risk of the project. So sometimes we can adjust them upward or downward. It is more realistic to use an interest rate that takes into consideration the risk of the project. Now, when it comes to investing in or taking on the project, there are things you want to look at. what is going to be my return when I take this project on. The return on investor capital, or simply the return on capital, is the no part divided by average book of total capital. Total capital here is debt and equity. Because the ROIC measures after tax return and the amounts invested by both equity invested and debt holders, we can compare the company's WACC to its return on average investor capital. WACC is the weighted average cost of capital. So that means that investments that have return on capital higher than WACC would have also a direct effect on the shareholder wealth, and the company's management to be increasing value by taking on those investments. When it comes to taking on or making a decision about capital investment, aside the NPV and the IRR and the returns, there are other things to look at, and they're called options. Options here are like the options we have in derivatives. And just like the name says, there are options, which means they give you a right, but not an obligation to do something in the future. And those options are, number one, timing options. And the timing option is an option in which you are allowed to take your time to decide on the project so that you have more visibility to make a better decision. An abandonment option is an option in which, in going into the project, if at any point or at some point in the future, you calculate that the cost of the benefit of abandoning the project outweighs the benefit of continuing in the project, you can go ahead and abandon the project. Let me add a bit of context to this. What this means is that there are some projects that you go into, you do not have abandonment options. It means as you go into, because of the amount of money or regulatory whatever around it, you can't abandon it. You have to see to the end whether or not you're making a loss. Expansion projects are those projects in which, as you go into it, you see that there's more profit to be made, you have an option to expand and do more. Flexibility options are those ones around price setting and production flexibility. Price setting options are options in which, when the demand for a product is high, you have the ability to increase your prices. This will have something to do with the elasticity of demand, because if you know that adjusting your prices will affect your demand, then you don't want to go into that. But this is beyond the scope of this reading, but just adding a bit of context. Now, production flexibility options are ones in which the machinery or the resources you have can be easily switched into the production of something else. For example, I'm going into a bakery business. I set up my bakery, my ovens and whatever, and at some point, all I was producing was bread. Along the line, I find that here in Abuja that I am, most people are going into the demand for chin-chins higher. I can decide to go into chin-chin production. What I have there is a production flexibility option. Fundamental options are ones in which going into the business itself is an option. For example, you can decide that when the demand for copper is high, you want to set up a copper mine. Now, one thing to know about options is that they give you a right, but not an obligation, but these rights come at a cost. So when analyzing your project, you look at the cost of the option and the value of that option. So you add the value and you take out the cost as what it is costing you to be able to exercise that option. And then from that, you decide whether your project will be valuable or not. That brings us to the end of capital investments and capital allocation. Sorry, I forgot to mention one thing. In capital allocation, we have some pitfalls. Sometimes, like I said, some costs should not be included, but sometimes it can mistakenly, people mistakenly add them in analyzing. Also, cash flows can be poorly estimated. I see a question in the chat box. Okay, it's not a question. Okay. Okay, business models. Now, when we go into business, there's something that we want to do. You decide, okay, I want to start to produce perfumes, for example, because in Nigeria, I believe there are not enough perfumes, right? When I go into a business, I must have a business model. My business model will explain how I want to provide my service, how I want to find my customers, how I want to deliver my product. Basically, it just tells an outsider how I want to run my business. Now, a business model is not a financial plan. A financial plan is usually a detailed calculation, estimation of finances. It's usually around projections of revenue and expenses, and what have you. But the business model is simply, how do I want to run my business? And the business model should answer this should do the following: identify identify a firm's potential customers, describe your products and services, describe the key assets and suppliers of the firm, explain how to sell its products and services, and explain its pricing strategies. Now, what are pricing strategies? There are different industries that we have when it comes to business models. Some companies operate in industries where they're price takers. They can't really dictate the price. An example is oil and gas. And others operate in industries where they have the pricing power, like, for example, where you have patented drugs and they're able to, let's just say they have a lot more pricing power compared to industries where the organizations are price takers. Now, talking about pricing power, this directly leads to what we mean when we say pricing discrimination. And this refers to being able to set different prices for different sets of customers. And I'll just go through a few examples. And number one is tiered pricing, in which we say, for example, the more you buy, the cheaper it will be for you. Another one is dynamic pricing, where you have different prices depending on the time of the day. Some people will say that if you buy a ticket in the middle of the night, it's cheaper. And you have things around how summer tickets and December tickets are off the hook. We also have value-based pricing, whereby the pricing is based on something, the value that the world basically places on it at the time, for example, a new drug. And then we also have auction pricing like we see on eBay. We also have pricing models for multiple products, and we see real life examples in some of the things that we do every day. For example, price bundling. You buy something and then other things are complementary. For example, most fast food joints. I remember the other day I went into Burger King and then I wanted to just buy a burger. And then I asked her, okay, how much is the meal? I realized that it was much cheaper for me to buy a meal that comes in my chips and drink, because most of those things are reduced and then are put together almost as complementary. So it costs almost nothing to put them together against if I was buying them separately. Another one is razor and blades, and which is selling a product or equipment at a low price and profiting by selling customers consumables after it. A good example is a SIM card. Right now, I think SIM cards in Nigeria cost 200 naira, but that's not your real problem. The real problem is the cost of data and cost of airtime. Then there's something called add-on pricing or which are options or add-on price with higher margins are added to the product after the purchase decision has been made. For example, sometimes you have video games. I remember buying a video game for my children the last time, and then we just realized later that the cost of the control pad, the cost of downloading the games was a lot more than even the game. I mean, the game was one-off, I could go away with it, but we had to keep buying games, cartridges, and softwares for them to be able to use it. And then other pricing models we have include penetration pricing, where you sell at a low price at the beginning to grow your market share. A good example here is Netflix. When Netflix started, you could share your password and login details with so many people, and it was almost at nothing. After a while, they started to cut all those things down so that they can enjoy their higher profits. We also have freemium pricing, where you offer a basic functionality at no cost, but for you to now get more, you have to pay a lot more for it. Another one is hidden revenue, where you offer online content. For all the viewers, it is free, but people who advertise, what we now look at and buy things based on the advertisements, pay for that. We also have pricing models that are alternatives to outright purchasing. For example, subscriptions, licensing, and franchising. A good example of subscriptions is what you have with a lot of the Microsoft Office suites now. Before, and I'm not sure how it worked, but I know now that for you to be able to use the Word, Excel, PowerPoint, and what have you, you have to pay some sort of subscription, I think yearly or over a period of time. Because my office pays for me, I honestly don't know, but I think that you have to pay, I think it's yearly, I'm not sure, but that's what I mean. It's against outright purchasing of using the software, you have to pay subscriptions. Even our DSTV here, you have to pay your annual subscription. Now, when it comes to the business model, your value proposition and your value chain has to be clear. Your value proposition is how your customers value the characteristics of the product service, even in competing products and their prices. On the other hand, how the firm executes the value proposition is referred to as its value chain. A value chain comprises of the assets of a firm and how its organization will add value and exploit the firm's competitive advantage. For example, pardon me, I'm a foodie. Because I order food a lot, most times when I want to order from this fast food, I'm always looking for the ones where I can order online and where delivery is fast. Right now, if you ask me if I sit in my office, I know the ones where I can order on my phone. I know the ones that are on Glovo app, and I know the ones that are on Jumia app. All of those things are the advantages aside what the company is producing that gives it a competitive advantage over other organizations in the same industry. So apart from industry-specific business models, other business models include private label manufacturers, where they produce, a manufacturer can produce for different brands to sell under their own name. Another one is value-add resellers. And a lot of this you find in the auto industry, where after buying a car, there are other things you can add on to it. And the last one is licensing agreements, where you're allowed to use someone's license to do something for a period of time. That is all about business models and risks. Okay, you know what? I've seen your question, Emmanuel. I think it might be safer for me to take all of the questions at the end. I think there's one more question. Let me look through the group. So I'll take all of the questions. Okay, now I see what's the difference between ROIC and ROCE. I'll take it very shortly. Difference between add-on pricing and razor blade pricing. Okay, I'll take those questions at the end. Let's just, because we have just 1 hour and we still have about 4 readings to go. Gloria, because I'm projecting, I don't see my time. Please, how many more minutes do I have?
Hi, good morning. You have 33 more minutes.
33 more minutes. So okay, let me move with the speed of light and then I'll come back to all of the questions. Okay, so investors and other stakeholders. Now, who are the owners of a business? The shareholders. But the sources of capital in a business are debt and equity. So the debt holders have a legal contractual claim on its interest and payment from the company, while the owners have residual claim. I kind of touched on this before. So what this means is that in case of anything, debt holders have priority. They will be paid first, while shareholders have residual claim. Whatever is left is what they will share. If there's nothing left, they don't get anything. If whatever is left after all of the interest and the principal of the shareholders, of the debt holders have been taken care of, is what the shareholders will get. Now, what this means is that it creates some sort of conflict. It is possible that if an organization loses all of the entire investment, everybody loses everything. That's both, pardon me, please, both debt holders and shareholders. But when everything is not lost, there is priority in terms of what is being shared. So what typically happens is that shareholders are prone to taking decisions that improve their growth over time. But debt holders are more interested in decisions that help the organization just pay on their debts. So in doing that, there's a conflict of interest. Issuing additional debt as opposed to equity also prevents the shareholders, also prevents dilution of shareholders' proportion of ownership. So for these two reasons, it is easier, let me put it this way, shareholders prefer debt because they know that at the end of the day, they can make more profit from that. It doesn't dilute their interest, but debt holders are aware of the fact that the more they increase this, the more difficult it is for the organizations to be able to pay back their debt. So increasing leverage and therefore risk can increase the return on equity as long as the expected rate of assets exceeds the cost of debt, but over what period of time? And in the short term, what happens to the ability to pay back debt? Now, in an organization, there are different stakeholders. The primary ones that we all know are the shareholders and the managers. because the shareholders are the owners of the business, and then they appoint managers and then the board of directors to take care of their business for them. The primary stakeholders of a corporation, aside the ones we've mentioned, include debt holders, senior management, employees, creditors, suppliers, and the government. And all of them have different stakes or different interest in the business. Now, there are two theories to take care of all of these stakeholders. There's a shareholder theory that focuses primarily on corporate governance that takes into consideration only protecting shareholders' value. Now, there's another stakeholder theory, which is broader, and it postulates that a company needs to balance the interests of all of the stakeholders. So you see the difference here. The shareholder is only taking into consideration the interest of who? The shareholders, and it takes into consideration the conflict between the shareholders and the managers, which is senior management people doing the day-to-day running of the business. But the stakeholder theory, on the other hand, is saying that all other stakeholders should be taken into consideration, and then looking at how the relationships amongst all of them is not affecting or is not focusing on one person too much, so that everybody's claims or everybody's interest is somehow protected. Now, when it comes to corporate issuers, the ESG factors that investors will consider. And investors who take stakeholder perspective are interested in ESG factors for three main reasons. Number one is that government stakeholders increasingly prioritize climate change and social policies through regulatory changes. Number two is that the impact that ESG factors can have on the company, things like potential loss, goodwill, financial losses, poor corporate governance may also lead to senior managers exploiting shareholders to advance personal interests. And lastly, many younger investors are increasingly managing their wealth with ESG considerations in mind. Now, to put this more in context is to understand things like negative externalities. And we see it a lot in the news, and seeing how one company is doing something, one organization is doing something, is making profit, but is affecting, for example, a whole nation or a whole, even other industries based on what they're doing. And this arises when a company or its investors do not bear the full cost of its actions. These are, for example, environmental damage. Increased government regulations and stakeholder awareness necessitates that companies should recognize this cost, and either explicitly in their financial statement or implicitly. Now, when we say ESG are environmental, social, and governance, corporate governance. So environmental factors include contributions to climate change, like I said earlier, air and water pollution, deforestation, energy efficiency, waste management, water scarcity, and what have you. Social factors include protection of customer privacy and information security, which is a real big deal these days. I don't know if some of you are aware of what happened with Facebook and the suit he had, the legal battle he had the other time about using people's information. Customer satisfaction, employee engagement, diversity and inclusion. We find a lot now in the workplace where the rights of women and the rights of even children in some societies are being protected. And that's why you have the goals of the 19 UN SDGs, and most of them in most organizations now are being taken into consideration when looking at, say, for example, the governance or the financial structure of the organization. The last one is corporate governance, and these are factors that include the composition of the board, the executive composition, the internal audit function, bribery and corruption, and other things around political contributions, and then lobbying. And that brings us to the end of investors and stakeholders in the business. Now, diving a little bit more into corporate governance and conflicts and mechanisms of what happens between stakeholders in the business. Like I said, there are different groups of stakeholders in the business. We've talked about the shareholders. Even amongst the shareholders, there are different groups of shareholders. Then there's government. There is a staff who the business is their form of livelihood. There are suppliers who supplying to that business is their form of profit. There's a government who has a stake, because now organizations are interrelated. The breakdown of one industry may affect so many industries, leading to recessions or unemployment, which in most cases is a challenge of most economies. Most economies' major challenge is to take care of what? Inflation and unemployment, and all of these things are interrelated. Now, there's principal-agent relationship and the conflict that arise because of this. In an organization setting, the principal are the owners of the business, who are the shareholders. The agents are those who have been employed to take care of the business for them. So because both parties might have different interests, conflicts might arise. The principal-agent relationship refers to owners employing agents to act in their interest. But conflict can arise because agents' incentives may not align with those of the owner, or more generally, because the interest of one group within a corporation is not the same as the other. Now, this leads to agency costs. Agency costs are costs in which, so those agents try as much as possible to align the interest of the managers with theirs. And the cost, they can be direct, which is the cost of hiring people to even monitor what the agents are doing, or they might be indirect in terms of opportunity cost of lost business. This relates directly to the decisions that the managers make that are not direct, that are not in favor of the agents. Now, different types of conflicts that might arise. Number one is conflicts of interest between shareholders and the managers or directors. That is the most common one. There can also be conflicts between groups of shareholders. There can be conflict between creditors and shareholders. Now, there are different mechanisms to manage all of these stakeholder relationships. Number one is corporate governance, and corporate governance refers to the internal controls and procedures of a company that delineate the rights of and responsibilities of the various groups and how this conflict of interest to be taken care of should they arise. Now, what is stakeholder management? Stakeholder management refers to management of company relations with stakeholders and is based on having a good understanding of stakeholder interest and maintaining effective communication with all of the stakeholders involved. Now, what are the ways of managing all of these relationships? We have the stakeholder mechanism. Corporations, would you typically do what? Hold an annual general meeting at the end of a fiscal year, which is a financial year. It doesn't have to be December, the financial year of that company. And then all shareholders are allowed to be part of a meeting, and those who are not part of the meeting can vote by proxy. In such meetings, ordinary resolutions such as approval of auditor, election of board can be decided upon. But sometimes when major decisions like takeover or mergers have to be taken, then they might have to have an extraordinary general meeting, and those resolutions are called special resolutions, and they require supermajority votes. Supermajority votes will mean something like 2/3 or 3/4 of the shareholders have to vote before a decision can be made on such activities. Now, we said that different groups of shareholders and conflict of interest might even happen between those group of shareholders. The activist shareholders who are very involved and want to pressure the company to make changes that will benefit them. The problem is that the changes that benefit them might not benefit the wider universe of all of the shareholders. Sometimes a group of shareholders might initiate a proxy fight in which they seek proxies of shareholders to vote in favor or of its alternative proposals. These are always in which shareholders come up to fight or ensure that something happens in their favor. Now, we said that when it comes to stakeholders, there are different stakeholders. We've talked about how shareholders are being protected in terms of annual general meetings. We call that the stakeholder mechanisms. Now, we also have creditor mechanisms, and this includes ways in which the creditors to the firm are being protected. It includes bond indentures. Bond indentures are covenants that have been put in the debt agreement, which says that you mustn't exceed or go below certain rules. For example, you mustn't go below certain debt ratios, and you mustn't take on those things always they vary, but what it really does is that in the bond indenture, it protects the creditor. There are also creditor committees in where a group of people come together to ensure that all of their members are protected. Now, we also have mechanisms to protect the employee, and the one that is most common that we all know are the labor laws and unions, in which there are basic rights of the employees that must be taken care of. Contracts are the employee mechanisms also for example, in your contract of employment, there are things that are stated there, which means that If any of those things are violated, you have a right. Also for the suppliers, they have this contract to protect their rights in case of anything. Now, we also have government mechanisms. Like I said earlier, government also has interest in the businesses because of the interrelationship between organizations, industries, and the economic growth. So governments will usually enact and enforce regulations that govern companies and actions, and they often do so by establishing agencies and regulatory industries. We have that in Nigeria. We have the SEC, we even have the CBN, we have the NAFDAC, what of you? Just name them. So there are different mechanisms that really do take care of each of the different stakeholders in an organization. Now, like we said earlier, the owners of the business are the shareholders. They can't manage the businesses themselves. So what they do is they appoint managers. They also don't have the expertise to oversee the operations of the managers. So what they do is they appoint the board of directors. Board of directors directly oversee what the managers do. The board of directors is elected by shareholders to act in their interest. And the board of directors typically has committees made up of members with particular expertise. And these committees report to the board, which retains the overall responsibility for the various board functions. And these are some examples that we have. We have the audit committee that oversees financial reporting function and the implementation of accounting principles. We have the governance committee that is responsible for overseeing the company's corporate governance code. There's a nomination committee that proposes qualified candidates for the election of the board. They manage the search process and attempts to align the board's composition with the company's corporate governance policies. There's also the compensation committee, which recommends the board's the amounts and types of compensation to be paid to the directors, senior managers, and employees. And then we have the risk committee. And with this, the risk committee informs the board about appropriate risk policy and risk tolerance of the organization and oversees the risk management process, ensuring that the risk that is being taken is optimal for the organization. So at every point in time, there's a risk budget, and this committee ensures that the risk budget is being adhered to. Now, we've heard a lot about corporate governance. The thing about corporate governance is that when it is poor, it has its risk, and the risks include weak control systems, poor decision making, the legal risk, reputational risk, and the default risk of paying back. Now, on the flip side of this is good corporate governance, which can improve operational efficiency and performance. It will reduce the default risk and reduce the cost of debt. Ultimately, it's going to improve reputational risk and improve financial performance and increase firm value, which is the reason why most times we're in business. Now moving on, we're going to capital structure. How many more minutes, please?
I have 17 more minutes.
17? Okay.
Yes.
Okay, get in there. Okay. A company's capital structure affects how it's financed its assets. Like I said before, your cost of debt, your source of capital, your debt and your equity. In general, a company will choose a capital structure with weights of debt and equity that minimizes the weighted average cost of capital. So when we discuss cost of capital, we use market values of both the debt and equity and not the balance sheet. But what is WACC? WACC is really the cost of your debt and the cost of equity. In the case of debt, it is tax deductible. So in calculating the cost of debt, we take out tax. Equity is not tax deductible. So what you see on the board, your WACC is the weight of your debt multiplied by the pre-tax cost of debt. Now, the pre-tax cost of debt would have taken away the tax. So it's tax deductible before you multiply it by the weight, and then the weight of equity multiplied by the cost of equity. Now, the weight for debt and equity can be target weight or market value weight. Analysts often estimate companies' target weights based on book value of the debt. There are factors that affect capital structure and the weighted average cost of capital. And this we may view these factors that affect capital structure as those that determine the company's determine a company's capacity to service debt, and they may also be internal or external. Now, what I'm saying is that a capital structure means how much debt and how much capital do you have, right? Now, your capital structure, the factors that affect this structure also those that affect your ability to pay back your debt, and they might be internal or external. Internal factors include things like the characteristics of the business or the industry. If you're in a business where cash flows are quite stable, it is easier for you to access debt. Also, if you're in an industry where it's blooming, doing well, and you're at the mature stage, then it is easier for you to access debt. But if you're in an industry that is just growing, where there are no records or where your cash flow is not very stable, it is a lot more difficult to access debt. Now, the existing debt level in your portfolio can also affect the amount of debt you can take on. One, because there are debt covenants that you have to fulfill. Number two, because more debt increases more risk. Another thing that affects the amount of debt that can be taken is corporate tax rate. Like we said earlier, debt is tax deductible. What this means is that debt can be generally cheaper, but it is cheaper. How cheap it is directly dependent on the tax rate that is being that applies to your debt. I've talked about the life cycle stage of the business, and then lastly is the management preferences. Some management will prefer to take more debt to grow the business, while some management will rather use a internally generated source of funds. Now, the other factors which we generally term the external factors, and these are market and business cycle conditions, regulations, because in some industries, the government regulates even the amount of debt that you can take, and then the industry norms, meaning that generally in that industry, there's a level of tax that most people go into. You don't want to exceed it so that you can maintain, you can be within the industry standards. Now, the company characteristics that influence the portion of debt in the capital structure include the growth and stability of the revenue. I've talked about this just before now. Growth and predictability of cash flow. The more predictable your cash flow is, the easier it is for you to access debt, and the more you want to access debt. Now, the amount of business risk in your business, the amount and liquidity of a company's assets. This speaks directly to, for example, if I'm going to take a loan from a bank, if I have assets that are stable and can be easily used as collateral and easily convertible to cash, this speaks to liquidity. Then my access to debt will be easier and cheaper, because my creditors know that if push comes to shove, they are able to take on my assets and convert it to cash very easily to take care of what I owe them. In general, the more stable, predictable, and recurring that the company's revenues and cash flows are, the higher proportion of debt it can have in its capital structure. Now, the emphasis here is that that's in general. There's still the aspect of what is the management preference in terms of how much debt they want to have in that structure. The types of assets companies use to generate revenues also affect the ability to issue or service debt. For example, creditors tend to view tangible assets as better collateral than intangible assets, especially when those assets can be sold for cash, just like I mentioned earlier. Now, in addition to these types of assets, other issuer-specific conditions include the levels of existing debt and volatility of revenues and earnings. Now, based on this, we're going to go to Modigliani and Miller's propositions about capital structure. So Modigliani's proposition 1 without taxes states that under certain assumptions, the value of a firm is not affected by its capital structure. And this is referred to as MM1. And the assumptions that lead to this are: number one, capital markets are perfectly competitive. In the real world, are they? Number two, investors have homogeneous expectations. Number three, there's riskless borrowing and lending. Number four, there are no agency costs. And number five, investment decisions are unaffected by financing decisions. Now, these are the assumptions under which postulated their findings. They are assumptions. But the question is, in the real world, do they really exist? So the diagram here is showing what MM1 is saying. Whether it's 40% equity or 60% debt, or 60% equity or 40% debt, it is the same because it is a pie. The value of an organization is unchanged. Now, there's proposition 2, and this is framed in terms of the firm's cost of capital rather than the firm's value. And based on the same assumptions that I read out before, MM2 states that the cost of equity increases linearly as the company increases its proportion of debt financing. Do you understand? Now, let me explain this. So what this means is that even though debt is tax deductible, the savings from increasing the amount of lower cost debt financing is just offset by the increased cost of equity capital. So based on this relationship, MM2 concludes that a firm's WACC is unchanged by changes in the proportion of debt financing in its capital structure. Now, MM1 states that the value of a firm is not affected by capital structure. MM2 concludes that the firm's WACC is unchanged by changes in the proportion of debt financing in its capital structure. So it concludes that the firm's WACC is unchanged. That's the difference. Now, when we bring taxes into the consideration, MM1 with taxes concludes that a company's WACC is minimized and its value is maximized with 100% debt financing. This differential tax treatment encourages firms to use debt financing because debt provides a tax shield that adds value to the company. But in the real world, can anybody take 100% debt? There are different reasons why this will not happen. First of all, there are regulatory reasons why one can't do that. Aside this, there are things that there's something called the cost of financial distress. The assumption is that there's no bankruptcy cost according to the 5 assumptions of MM. However, we can expect that this cost to happen, and these costs are called cost of financial distress, and they tend to increase at higher levels of debt financing. Cost of financial distress are increased costs that a company faces when earnings decline at a point where it has trouble paying back its interest on its and principal on its debt, and they can be seen as this: cost of financial distress and bankruptcy, and the probability of financial distress. Now, what typically happens is that because of this, you find that a lot of times in the real world, nobody takes 100% debt as their capital structure. Now, that brings us now directly into the static trade-off theory. And the theory seeks to balance the cost of financial distress with the tax shield benefits from using the debt. Now, what MM is saying is that you should take 100% debt because debt is cheaper. But what this is saying is that you should take debt up onto the point where taking on any extra debt will not be beneficial to the organization. So what this means is that there is an amount of debt financing at which the increase in the value of the tax shield from additional borrowing is exceeded by the value of reduction in higher expected cost of financial distress. This point represents the optimal capital structure for a firm. And this is also where the WACC is minimized and the value of the firm is maximized. Now, every organization has a target capital structure. To maximize its value, a firm seeks to achieve a target capital structure. On an average over time, this will reflect management's belief about its optimal capital structure. In practice, most times, these things fluctuate, and that will be because of market values of firms' equity and debt that fluctuate. And then at times, a management might want to quickly take advantage of opportunities in the short term to do something outside what is stipulated in their capital structure. Now, we've talked about conflict of interest, and I've talked about principal agent conflicts. One of the things that this brings to light is the cost of asymmetric information, which arises because the managers typically have more information about the company's prospects and future performance than the owners. This might also lead to a reason why the capital structure fluctuates from time. Now, there's agency cost of equity, and I've talked about this before, and they're related to conflict of interest between managers and owners, and they include monitoring costs associated with supervising management, bonding costs of assuring that shareholders and management are working in line with what is best for the shareholder, and residual losses that may occur even with adequate monitoring and bonding provisions. Now, what is agency theory? It suggests that greater financial leverage tends to reduce agency costs because the use of debt gives managers less free cash to follow, less free cash flow to use imprudently. Now, there's also the pecking order theory, which suggests that managers prefer to making financial choices that are least likely to give the general public a negative signal. So financing choices follow this hierarchy. And based on this is because this is affected directly by what is visible to investors or to outsiders. The number one and most preferred one will be the internally generated capital. Number two is the debt, which can be issued, and external equity, which is the least preferred because of the signal that it might be sending to outsiders. This is the last reading. How many more minutes, please?
5 more minutes.
Okay, let's try to do this in these 5 minutes that we have. So companies usually choose financing resources based on cost, the risk, and the flexibility. We have internal sources and we have external sources. Internal sources, of course, are cheaper. External sources, even though they're more expensive, sometimes they're not readily available, depending on the industry and the level of maturity of the business. Large financial organizations usually have access to lines of credit, and they may be committed, in which a bank extends an offer of credit for a certain amount, but may refuse to lend it if circumstances change, or committed in which they're not able to make any decision as to whether or not they can take it back. Now, companies with weaker credit may have to pledge assets as collateral for borrowings. And also what this means generally is that it will be more expensive for them. Secured asset-backed loans are backed by collateral, for example, fixed assets, receivables, or inventories. Factoring refers to the sale of receivables to a financial intermediary as a discount for their face value. Now, companies may raise capital by issuing public debt. That's by when they trade in the public market, or private debt provided by private entities not actively traded. Interest rates on companies' debt depend on current market conditions and companies' creditworthiness and collateral. What this means is that generally, the more creditworthy you are, the lower the cheaper it is for you to access debt, and the market condition affecting your industry or your own organization as a whole also affect the interest. Generally, it is cheaper for bigger organizations and most stable organizations and smaller organizations. Large creditworthy companies often issue short-term debt securities in terms of commercial papers, and the companies sometimes sell common equity. And from what we said before, you can tell that it is the least form of raising capital in terms of financing the company's needs. Companies that have access to and utilize public debt markets tend to match the securities of their outstanding debt to the lives of their various assets. They just make sure that there's no mismatch so that their assets mature at the time it's time for them to also pay back the debt. Companies with significant operations and assets outside the country will often finance them with debt limited in that currency. A company's need to carry inventory, its liquidity requirements, extension of credit to customers, and its use of trade credit all factor it into its working capital management. Now, to manage working capital, companies may employ a conservative strategy in which they have high current assets as a percentage of sales, or an aggressive one where they have a low current assets as a percentage of sales, or something moderate in between the two. Conservative strategy, of course, provides greater financial flexibility, while the aggressive one increases return on assets. So financing current assets with equity or long-term debt is considered conservative, while financing current assets with short-term debt is considered aggressive. That's quite explanatory. Some companies finance current assets they view as permanent with equity or long-term debt, while financing seasonal or variable current assets with short-term debt. Choices of short-term debt funding and they vary. A company's short-term fund plan should ensure that it maintains sufficient borrowing capacity to meet its ongoing needs, including seasonal, other times, or peak requirements. Primary consideration when choosing a strategy for short-term funding is cost. Like we said earlier, the cost of funds is really your interest rate, and a lot of things to put into consideration that affect the cost. But in deciding the funding option you would choose, it is important to consider which one is less costly for the organization. Companies that rely on significant short-term financing should use more than one type of financing and multiple lenders. Even companies that rely on one particular type of funding may find it advantageous to work with more than one lender, and maintaining excess funding for unforeseen events to take advantage of business opportunities is important. Even though you maintain this excess funding to take advantage of these opportunities, all of these come at a cost. So at some point, you then need to manage which one outweighs what. And the primary sources of liquidity company normal sources of short-term cash, selling of goods and services, collecting receivables, or using trade credit or short-term borrowing. Secondary sources of liquidity and measures of company must take to generate cash when its primary sources are inadequate, such as liquidating assets, renegotiating debt, or filing for bankruptcy. And there are drags and pulls on organizations' liquidity, including uncollectible receivables or debt, obsolete inventory, tight short-term credit, and poor payables management. There are different ways to measure companies' liquidity: the current ratio, quick ratio, cash ratio, your receivables turnover, inventory turnover, payables turnover, operating cycle, cash conversion cycle. Because of time, I'm not able to take all of those ones one after the other. I'm sure the next speaker is here. Gloria, what we can do is we can collate the questions and send to me via chat. I would answer them and send them back. I'm sure that when my 1 hour is over, I hope that I didn't take too much of our time, and I hope that I was able to add some sort of value. For those writing in this February, I wish you the absolute best in your exam. My name is Mukwelola Jato. Please feel free to reach out if there's any way I can help you. You can find me on LinkedIn. And yes, I live in Abuja. Thank you so much for your time, and thank you for having me.
Thank you so much, Mokwe. We're really grateful for that. The next session we're going to have is Ethical and Professional Standards by Ms. Adiola, who is, I believe, already on the call. So you can just go ahead now. Thank you.
Okay, thank you. Good afternoon, everyone. My name is Adiola. Nice to be with you all. Could you stop sharing that other one so that I'm able to share my screen? It's showing like someone is still sharing the screen. Okay, perfect. Thank you. Please confirm if you can see my screen so I can just go
Yes,
ahead.
we can see your screen.
Okay, thank you. Excellent. Okay, so good day, everyone. So I'll be taking ethics and a little preamble first, and then we'll go straight in. So you can chat the questions to the chat, but the approach I like to take is that we talk about some of the critical parts of the course and then take some quizzes that would show. We might not be able to cover everything in 1 hour, given that it's a lot and the weight is about 15% to 20%, but we'll see how many we can cover. And then I can share the slides. And also when I'm talking about preamble, I'll give some tips that can, help you as you prepare for the exam. And I wish you the very best. So let's just dive right in. Okay, so like I said, I think the cost is very important because of the weight. So that should actually be 15% to 20%. Apologies for that. And also something we call ethics adjustments, which means if you're actually close to the, to the pass mark and you do very well in ethics, that could be what push you to actually, make it through the level 1 exams. And another interesting thing is that anything you learn, even as you're preparing for level 1, you would still find it useful in level 2 and in level 3. So it's very, very key. Another thing that I want to point out is when you're answering any question on ethics, I hope you can hear me okay. All right.
Yes, we can hear you well.
Excellent. So, and anytime you're trying to answer a question on ethics, it's important that you watch out for the statements that are in the question. Because another thing is you might know the answer, but you realize you're answering the question that is not being asked. So it's important to watch out for general statements. So the standard may have said something around, oh, it's good to have this, but he didn't put like categorically saying all the time. So you need to watch out for general statements and also note keywords in the question, such as least likely, most likely. Those words actually change what the answers will be. So it's really important. Immediately you see it in the question, maybe you want to note it before you answer, because the most painful thing is to realize you know the answer, but you answer the question that was not asked. Another thing I want us to talk about before we dive into it is that the end of curriculum summaries are very, very key. Now, for ethics, apart from the learning outcome 1, you won't see a lot of summaries in there because it's a lot about the application and the practice questions. but this also applicable to all the other courses you're taking. If you can do it, you can actually aggregate all the summaries on each of the lessons, and then that will form your revision. There's a lot of value in doing that. And for ethics, there's actually no shortcut. You need to actually read the curriculum, practice the questions, both the ones that are like end of chapter question and also the question banks. It's very, very important because sometimes ethics is nuanced. It's actually read it that you'll be able to see, some of the issues that might be there in the question that is presented to you. And there's this link that will drop in the chat later that CFA actually did. It has like a 2-page document that summarizes all the standard and also the code of ethics. So it's like a short form that you can always refer to that can assist you in your preparation. So let's dive right in. So what are ethics? Ethics encompasses a set of moral principles and rules of conduct that provide guidance for our behavior. In a nutshell, it's all about, values. You hear people say, oh, this is what guides my behavior with other people. And it's actually about moral principles and ethical belief. The easiest way to remember it is how we think of integrity, and how we believe, oh, this person has integrity, this person doesn't have it, so that's the key thing. So it then elevates it to say that we have societal groups and communities, that come together and are bound by a code of ethics, such as the CFA Society, and then you move on to say, when you have a code of ethics, you still have to define the minimally acceptable behavior of the members of that community or profession, that will typically clarify the code of ethics. So it's like the standard breaks down that code of ethics into the behavior that is acceptable and what is not acceptable. And then we talk about the fact that profession, when we talk about it, is actually much more serious than any other kind of society you might have, because people then rely on you, and then trust is critical. So let's just take this short quiz. Let's see how the answers come to say where we are. So the first one says, which of the following statements is most accurate? Ethics can be described as A, a commitment to upholding the law; B, an individual's personal opinion about right and wrong; C, a set of moral principles that provide guidance for our behavior. So we can put our answers into the chat and we can see that. So 2 says, which of the following statements is most accurate? Standard of conduct are a necessary component of any code of ethics. B, they serve as a general guide regarding proper conduct by members of a group. C, serve as benchmark for minimally acceptable behavior required of members of a group. Let me see your answers coming through. Okay. We'll see the answers shortly. So 3 says, which of the following statement is most accurate? A profession's code of ethics, A, includes standards of conduct and specific benchmark for behavior. B, ensures that all members of a profession will act ethically at all times. C, publicly communicates the shared principles and expected behaviors of the profession's members. So that's question 3. Question 4, specialized knowledge and skills, a commitment to serve others, and a shared code of ethics best characterizes A, vocation; B, profession; C, occupation. So we'll see the answers shortly. So the important thing is to just see how you fared. You can see 1 is actually C. Ethics is a set of moral principles that provide guidance for our behavior. 2, when we talk about standards of conduct, they actually serve as benchmarks for the minimally acceptable behavior. And then you see 3, the code of ethics actually publicly communicates the shared principles and expected behaviors of a profession, or behavior of a profession's members. And 4, the profession is what we have just described here. So let's proceed on to the next slide. All right, let's take one more and then we go on. So how does ethical conduct most likely compare with what is legally required? A, ethical conduct goes beyond what is legally required. B, there are no differences between the two, they are the same. C, doing what is legally required removes the need for ethical conduct. Question 2, ethical versus legal standards. Which of the following statement is most accurate? All legal behavior is ethical. Some ethical behavior may be legal. C, legal standard represents the highest standard. Okay, question 3, challenges to ethical conduct. Which of the following will most likely determine whether an individual will behave unethically? 1, the person's character. 2, the person's internal traits and intrinsic motivation. 3, external factors such as environmental and cultural environment. So I'm waiting for your answers to that. Okay. 4, which of the following best identifies an internal trait that may lead to poor ethical decision making? A, overconfidence. B, loyalty to employer. C, promise of money or prestige. So let's see the answers. One moment. Oh, I think I'm having a little issue. Okay. So these are the answers. So ethics actually, ethical conduct goes beyond what is legally required, like we allude to, because, you know, ethics goes beyond what is legally required. You know, something can be legal, but not necessarily ethical. Like you could pollute an environment where other people are getting their source of livelihood. While it may be legal, it may not necessarily be ethical. So that's what we're talking about. And then some ethical behavior may be illegal. You see people protesting some things, and then it might be legal at the time, but may be ethical. And then sometimes ethics actually prevail in the future, where you then see them change the rules to actually support the ethical behavior. A critical part then to making sure that people behave in an ethical manner is actually how to deal with external factors. And then that goes on to talk about the fact that if you don't put that matrix or system in place, you could be overconfident thinking that you are actually ethical. So let's go into the Code of Ethics itself. So there are 6 pillars, which I believe we know. So for this one is to have an understanding of what is being described here, so that when you see it in questions, it jumps out at you. So this Code of Ethics apply to all members of the CFA Institute and then candidates such as yourselves. So the first one is that members and CFA candidates are to act with integrity, competence, diligence, and respect in an ethical manner with the public, clients, prospective clients. So you can just group every kind of people that we deal with in the profession, and other participants in the global market. So that's one. So it's around acting with integrity, competence, diligence, and in an ethical manner. 2, they are to place the integrity of the investment profession and the interests of clients above their own personal interest. 3, use reasonable care and exercise independent professional judgment when conducting investment analysis, making investment recommendation, taking investment action, and engaging in other professional activities. This just means that they need to use reasonable care and exercise independent professional judgment when they are going about their profession. 4, practice and encourage others to practice in a professional and ethical manner that will reflect credit on themselves and the profession. Next one is to promote the integrity and viability of the global capital market for the ultimate benefit of the society. This particular one is very key because, you know, it tends to be something that makes sense for, you know, examiners to test. The next one is to maintain and improve the professional competence and strive to maintain and improve the competence of other investment professionals. This is about actually getting better and doing things right. So, okay, sorry, before we go to the quiz, I want to talk about how the whole ethical thing is structured. So the first one is that everyone, all members and candidates are required to comply with the codes and standards. Now, this next point is important. You know, at this level, it's important to just get as many marks as possible. So sometimes some of this one that looks like, oh, they're not deep into the conversation, it could easily be a place where you can get easy and cheap marks. So one of such areas is when they say the CFA Institute Board of Governors actually maintains oversight and responsibility for the Professional Conduct Program, that's the PCP, and which in conjunction with the Disciplinary Review Committee is responsible for enforcement of the code. So here, what I want you to take from this one is around the governance, but anywhere you hear anything around oversight or responsibility, then you know it's about the board. Now, the other interesting thing is how, they then discharge their duties, especially in enforcing the codes and standards. So you think things around how do they even get, informed that someone is violating the standards. Typically, everyone would self-disclose when we are doing our annual, registration. You need to say if you've had any issue, you need to self-report, and then sometimes they could see it from social media. And then, of course, they investigate and they come up with decisions. And then we'll talk about some of the sanctions that they tend to impose. It could be public censure. They could actually suspend your membership and use of the designation. Or if you're already able to revoke your CFA charter, and if you're a student, it could be that you can actually not, continue with the program again. Now, there's another important part in this whole process. That is where someone actually, after they've investigated the person and they said, okay, these are the charges and the proposed sanctions. If the particular staff or candidate, actually protest saying no, they do not believe that that is applicable, then on their own, they can then do that. They can decline it, and then that case will be referred to the DRC. And now the role of DRC is to just decide after their own investigation to know if truly a violation has occurred, and then what sanctions should be appropriate. So let's look at some of these questions. So, okay, the first one says, which of the following statements best describe an aspect of the professional conduct program process? A, inquiries are not initiated in response to information provided by the media. B, investigations result in disciplinary review committee panels for each case. Remember what I said about things around making generic or general statements. Always be at alert when you see such. C, investigations may include requesting a written explanation from the member or candidate. Question 2, which of the following group is most likely responsible for maintaining oversight and responsibility for the professional conduct program? A, CFA Institute Board of Governors. B, the Disciplinary Review Committee. C, Professional Conduct Division. And then the 3, which of the following least likely? Remember, least likely. Immediately you see least likely, you should just note that so that you're not answering most likely. Reflects the 2 primary principles of the CFA Institute Rules of Procedure for proceedings related to professional conduct. A, confidentiality of proceedings. So it's least likely you're looking for the negative. B, public disclosure of disciplinary sanctions. Fair process to members and candidates. Let's see the answers we have coming. Okay, so let's see the answers now. One moment. Apologies, I think this thing seems to have frozen. Okay, so these are the answers. So investigation may actually include requesting a written explanation from the member or candidate. And also, like we said, anything that has to do with oversight, where the bulk of responsibility stops at, that is the Board of Governors. And then we just said it's about the negative. What would they not be doing? Of course, they have to keep the confidentiality of the proceedings. They have to be fair to members and candidates. So the negative one here is public disclosure of disciplinary sanctions. So we move on to the standards. So we actually have 7 standards, and then they have substandards. We will go right into it. And please remember, when I drop the that summary PDF link that the CFA Institute provides, I think it's good to have it, just handy. Just remember, it could be 20% of your whole marks. So now let's dive into it. So for standard 1, professionalism. So you remember that it's just about 4 substandard, and the first one is knowledge of the law. And the way to look at it is actually the key things I want to emphasize. Number 1 is expected that members and candidates must understand and comply with all applicable laws. That's the first part. And the next thing is, in the event of conflict, where the laws are not saying the same thing, which you could see, because typically you can have You can have different laws that apply to what you're doing, whether because of where you are. In the same country, you have different laws. The idea is to actually comply with the more strict law. That's the second critical part of knowledge of the law. And third thing is that when you do see something that is not ethical, you must not knowingly participate or assist in it. You must actually dissociate from such. You will see examples of that. So it's very important you comply with the law, you follow the more strict law, and then you dissociate. So for standard 1B, it's actually about independence and objectivity. This is about protecting integrity of opinions. That is the crux of this substandard. And it says that members and candidates must use reasonable care and judgment to achieve and maintain independence. So this has to do with, you don't want anybody to affect your decision, either through bribe, gift, or perceived, bribe as well. So members must not offer, solicit, or accept any gift, benefits, or compensation or consideration that could be expected to compromise not just their own independence and objectivity, but also someone else's. Now, this particular one is more important, especially in cases where a relationship doesn't yet exist. I'll give an example. That's, let's say, maybe you're trying to get me, I'm trying to win a mandate to actually manage your, pension funds, for instance. So I actually don't have a relationship with you. I also have a relationship with you. And then I'm offering to give you, gifts, maybe an all expense paid trip to the AFCON games. So that has, a way of actually, causing a bias. So that's what this substandard is talking about. Now, the substandard 1C, misrepresentation, that says you must not knowingly make any misrepresentation regarding all what you do, whether it's relating to investment analysis, your recommendation, your action, or any other professional activity. That's just about saying, be honest, don't lie, don't omit. That's what substandard 1C is about. Now, substandard 1D, that's actually so personal, which is about misconduct. It's saying you should not just be involved in things that has to do with dishonesty, fraud, deceit, something that can actually reflect poorly on the institute and on your integrity and that of the society. So I think I extracted this from the curriculum just so that we can have a discussion about this. When they talk about applicable law, this one is actually around that first substandard that says, in event of conflict, you must always go with the more strict law. So the way to look at it is that there are likely to be three applicable areas. One is that one person has strict law. One is that somebody doesn't really have any law at all. Then the other one, someone has, maybe low level of law restrictions. So the way you have to look at it is that your answers will ultimately be between two options. One, you are either following the more strict law or you are following the code and standards. So the way you picture it is that any answer you're thinking of, the first point must be at the minimum, it must be to adhere to the code and standards. However, let's say the country's law is now much more, stringent. For instance, let's say that, I'm just giving an example. Let's say that in a country A says, all is fair. All is fair pay. If you have insider information, you can trade on it. If you know tomorrow you're about to buy up a company, you can decide to do anything with that information. So you say that, okay, that is a country or a place that has, low, level of laws that apply to what you're doing. However, the code and standard prohibits you from that. So at the minimum, you would go with the code and standards. But let's say the table were reversed and the country says, because of that appearance of, insider trading, I would rather in any IPO that you are anchoring, you don't even participate. Now, the code and standard does not actually prevent you from doing that. But because that law in the country where you are operating says that is actually stricter, so then you would pick that. So this schedule just shows some of those kind of situations. As you can see, it's either you are following the code and standard, which is the minimum. You would never choose the one that is like a low kind of level of restrictions of the standards. You would always speak the code and standards or the more strict law of the country or applicable country where you operate. So let's look at more questions. So given that we've discussed ethics so far, you would think it's easy to just make a decision. But typically, dilemma would occur because things are sometimes not as clear when you look at it, maybe by yourself, and you need to consider a number of things. So let's take some of these questions. So it says, when an ethical dilemma occurs, an investment professional should most likely first raise the issue with a mentor outside the firm, professional bodies outlined, a senior individual in the firm. I'd like to see what our answers are to that. Correct. I'm saying C is coming through. So your first level of contact should always be your organization, probably your compliance team. That's where you always go to. Now, there's an interesting part I think I should mention here. Typically, you might see things around the questions, even in the curriculum, that are you required to actually escalate to regulators or blow the whistle? The standard is not requiring that. Of course, if need be, you may have to do that, So it's important to know those subtle way those questions are asked. So the next one says, according to the standards, a member who is asked to produce initial paid research reports is required to A, avoid cash compensation, B, disclose the nature of their compensation in the report, C, decline to write a report if the members first provide investment banking services to the issuer. Here we're saying things around, if you're going to pay me to issue paid research, I should still be able to, do the research and give my opinion and not feel like, oh, because you're paying me, then I have to give you a good rating. No. And at the same time, I need to be able to let the people that would be using the report know that I'm being paid to do this so that they can use that in their judgment to know whether I'm biased or I have ulterior motive. So that's why we have question 2 there. So question 3. Okay, sorry, question 2. Okay, yeah, we said that. Question 3, which of the following is a recommended procedure for compliance with the standard related to independence and objectivity? Members should encourage their firms to prohibit any employee participation in equity-related IPOs, remove a corporate client from research universe, put it on restricted list if the firm is unwilling to disseminate adverse opinion about the company. C, provide every client with the procedure and policies for reporting potential unethical behavior, violations of regulation or other activities that may harm the firm's reputation. The next one, according to the standard related to independence and objectivity, a gift from a client could be considered supplementary compensation. B, compensation arrangement should link analyst remuneration to investment banking assignments. C, portfolio managers may report sell-side analysts to covered companies if analyst changes in recommendation adversely affects the client's portfolios. So let me see the answers that are trickling in. Okay, so we'll see one moment. So this is, okay, we've talked about this. Yeah, so you should always report to the senior individual in the firm first. Then you should actually disclose the nature of the compensation in the report. So like I said, they'll be able to decide if you're being biased and to be able to make necessary adjustments to their decision because of that. Now, if you're doing other things for a company and you don't want to actually issue an adverse opinion, in that case, you could actually put it on a restricted list. And then a gift from a client could be considered supplementary compensation. Like I explained, there's this distinction that is important to note, that when you're talking about this independence and objectivity, there's one that is even frowned upon much more. So let's say you have a client and client says, oh, if you achieve this much performance on my assets under management, I'll give you a ticket to, say, return ticket to the UK or something like that. That kind of gift is still different because there's an existing relationship. Of course, you still have to have required approval and identify your organization, but that is different than from it being someone that is currying, favor or something from you. That is a totally different one. That's such almost seen as something to compromise, your independence and objectivity. So I think I'll just skip this so that, okay, another part I want to point out here under this independence and objectivity is things around travel funding. it's always important for candidates to actually, for practitioners to actually limit the kind of free access to travel and, would I say, residential or accommodation things that they receive from clients and prospective clients. Sometimes even if it's not something that is bad, it could have the appearance that the person is trying to buy. So the typical thing that we look at is that you then try to cover the cost of your own trip, and then, don't let the customer pick up your bill pretty much. So you see a lot of that when you're practicing some of the questions on the online question bank. Okay, so we move to standard 2. Standard 2, let's dive straight into 2A, which is about material non-public information. So this is saying that you cannot actually use any material non-public information that can affect the value of an investment or cause others to actually act on such information. What is material, you may say? Of course, let's say all of us at the beginning of the year knew where the stock prices of most of the stock would be by this time this year. And you had an inclination that, oh, this much is happening, that no one else knew. That kind of information will be material. If you know, oh, maybe a particular company is going to make triple what they've ever earned before, that's an information that I want to know, because that can affect the share price. That can impact my decision. That's material information. Then the other thing around whether information is public is it widely known, or is it just something the CFO or someone discussed with just one person? So, but there's an exception even to this rule, which is the mosaic theory. And that just says that an analyst may use material public information. That means, yes, the information is material. However, it's in the public space. If you Google it, you will see it there. But you can combine it with other non-material things and non-public information. Maybe I just saw, somebody just, I saw CEO of a company traveled somewhere. It's really neither here nor there. You can be traveling anywhere. But if I'm able to then distill that information with the other information that I already in the market, and like, oh, that ship is actually because he's signing this deal or he's doing this. And then on my own, I'm able to kind of synchronize all those information to make a decision, then that is acceptable. Okay, are you all still with me? I just want to be sure. Hello? Okay, I'm assuming that you can still hear me. So we'll go on to substandard 2B, which is—
yes, we can hear you.
Okay, thank you. Which is integrity of capital markets. And this is about prohibition of market manipulation, because members and candidates must not engage in practices that distort prices or artificially inflate trading volume. Here you could have information-based manipulation. That's where people spread false statements just so that they can impact maybe the prices of the shares. Or it could be transaction-based, where you're trying to do transactions that may distort, the regular price setting mechanism of financial instruments. So let's look at some questions. So the mosaic theory holds that an analyst, A, violates code and standard if the analyst fails to have knowledge and comply with all applicable laws. B, can use material public information and non-material, non-public information in the analyst analysis. C, should use all available and relevant information in support of investment recommendation. So let's see some of the answers. Okay, I think we can see people going for B. That is correct. So let's take one more and then, sorry. Okay, I think I'm already showing the answer so that we can just cover a little more. Okay, okay. So let's take the second one. I think is also important. So it says, which of the following member action most likely violates the standard relating to material non-public information? Action 1, an analyst buys call options on a stock after learning from the company CEO. That's definitely material. So materiality sometimes is determined not just by the information, but also by the person that is giving the information. For instance, if it's just the driver in the company that I say company will report earnings exceeding analyst expectation, well, it can be saying that really. When the CEO is saying it, that is material when it's not yet public. Action 2, an analyst buys an oil company stock after speaking to a well-known industry expert who believes oil prices will rise due to geopolitical risks. So you can see the person is just saying it based on his own thoughts and maybe analysis, not like he heard it from anywhere categorically. So it's action 1 that would be relevant in here. Okay, sorry. So let's go on to the next standard. So this is standard 3, duties to clients. So let me just run through the 5 substandards, and then I might have to skip some of the quizzes so that we can go on. And like I said, please don't forget, it's very, very important that the way you can actually get yourself ready for the ethics exam is to actually practice, the questions, both, the end of chapter questions and the question bank. And another thing I like to point out when you're practicing is that when you do those questions online, immediately you answer the question, it shows you like some comments as to why, your choice is either correct or wrong. Those information is very, important because it helps you understand everything. It can actually show you why a particular option is not correct. So in evaluating why that option is not correct, it gives you it gives you like a deeper knowledge into what it is that you are looking at. So I think that is also an important thing I like to point out. Okay, so back to the standards. So the substandard A is loyalty, prudence, and care. And this means that members and candidates have a duty of loyalty to their clients. You must always act with reasonable care and then exercise prudent judgment in all that you do. You must act for the benefit of the client and place the client's interest before your employers or your own interest. That is very, very key. Next thing is fair dealing. You must deal fairly and objectively with all clients when you're either providing investment analysis or making a recommendation or taking action. And so when we talk about fairly is that you treat your customers fairly. And then sometimes maybe I can make a distinction here that helps to when you're looking at it. Sometimes fairly and equally are actually different. Equally means you treat them the same, but no, fairly is much more robust. And I can give an example. So let's say, okay, I'm thinking about how best to express that. Okay, we'll see that in some of the quizzes. So let me still go ahead. So the next thing is around suitability. That's the substandard C. So you have to make reasonable inquiry into your client's investment experience, their risk and return objective, their constraints before you make any investment recommendation. And then judge the suitability of investments in the context of client's total portfolio. So you might come across questions that seems that, Adiola takes an investment call with Bisola, and then she says, oh, Bisola, I know that this particular stock will be very good for you. That's already a red flag. Number one, I've not even discussed anything with Bisola. Do I know her educational background, her goals, her risk and return objectives? I need to know those before I can then start saying this is the best thing for you to do. And the next thing is around judging the suitability of investment in the context of the total portfolio. I'm sure you're already learning that from all the other parts of the course, things around diversification. So you must always do that, make that consideration. You don't make a recommendation in isolation. You need to look at the total portfolio. And the next one is actually performance presentation. And this is saying that when you're making investment performance information available, when you're communicating it, you must make reasonable efforts to ensure 3 key things. It is fair, it is accurate, it is complete. Very, very key. The next one is preservation of confidentiality, which means you must always keep current, former, prospective client information confidential, with the exception of 3 cases. That is 1, if it is required by law, then that's the only time you can be saying you can, waive that. Or if the client actually permits you to do that, that's the only time you can do that. And under this standard, some of the things you will see in some of the questions is actually who is exactly the client. In some cases, it's easy to see, but sometimes you need to look, a little closely. For instance, when you're managing a pension fund, of course, you might think it's the pension firm that your duty is owed to, but that's not who your duty is owed to. Your duty, you owe a duty to the beneficiaries of that plan. So that's why it's saying that actually identifying the actual investment client is very, very important. So the duty of loyalty is owed to the ultimate beneficiaries, not the pension managers, so to speak. The next thing is that when you're actually developing a portfolio, you already have more knowledge than the person. So that's what we talk around things like fiduciary. So you need to actually act in a trustworthy manner and then look at that portfolio, the client's portfolio as a whole, not just looking at the stock in isolation. And another common ground for issues is how they use soft commission policies. So here is that the soft commission or soft dollar is an asset of the customer and should be used for the benefit of the customer, not the asset manager. Okay, so I think I put some questions here. We'll take 2 of it only, and then we'll move on. So it says, which statement about the manager's use of client brokerage commission violates the code and standards? A, the client may direct a manager to use that client's brokerage commission to purchase goods and services for that client. Remember what we said. He said which commission violates. So if it says violates, you are looking for something negative. So the client brokerage commission should be used for the benefits of the client and should be commensurate with the value of the brokerage and research services received. C, client brokerage commission may be directed to pay for the investment manager's operating expenses. No, we've already said that it belongs to the client, should be used for the client. So that's that. So I'll just move on. When I share this slide, you can see some of these quizzes, which I actually extracted from the curriculum, and you can also see that when you do that. Okay, so we move to the next standard, which is duties to employers. So I think I skipped something. Oh, apologies. Let me just see that. Oh, okay, I think I skipped something. Okay, but I'll just talk about it largely. So this one, number 1, we're talking about is loyalty. Here, you actually owe a duty of loyalty. Sorry, okay. Yeah, let's start with this slide and I'll just go back. Apologies, I think I placed it wrongly. So the first one is actually loyalty. So candidates and the members must act for the benefit of their employer and not deprive the employer of the advantage of their skill, ability, divulge confidential information, or otherwise cause harm to your employer. Employer is employing you, so you should be loyal and at least do, what you are paid to do. That's the nutshell. The other thing is around this additional compensation. And then saying that you should not accept gifts, benefits of compensation, or consideration that might compete with, or increase or create conflict of interest to employer's interest, unless you have written, keyword, written consent from all parties. Always remember, written consent from all parties. So I'm in an investment firm. Then somebody says I should manage maybe investments of people in my family. It's already related to what I'm doing with my employer. Those are the kind of scenario that shows that you need to have written consent from all parties involved. Very important. C, also things around, this C is about responsibility of supervisors. You need to make reasonable efforts to ensure that the people that are under your supervision or authority, complies with applicable laws, rules, and regulations. This is important because if you feel that you are not able to do that, then you need to decline that supervisory role in writing. I want to go to the previous slide that highlights some of the important areas. So of course, the employer too has a responsibility to provide a positive working environment, an environment where it's easy, for you to behave in an ethical manner. Now, this leaving an employee person is very, very important. So here, there are things that can, quickly be like a violation, which are things around misappropriation of trade secrets, misuse of confidential information, solicitation of employers, clients prior to cessation. But let me just give highlights of the way to think about this. So first of all, anything, any job or any model that you develop while you are with an employer, the right to that work belongs to the employer, not to not to you. And if you want to take it when you're leaving to another company, you need written permission to take that. Of course, if you are still in that organization and you want to start your own company or you want to go to another company, you're allowed if you don't have any non-compete clauses. But the important thing is that any preparation you are making towards going to that place, you should do it in your own time, not on the time of the employee. And then you cannot just be soliciting the current employer's clients. You know, that you can only do after you've left the organization, and if your non-compete is has lapsed before you can do that. And you can only actually contact them from information that is in the public domain, not just something that you have. Of course, the knowledge and learning that you've learned while you were there belongs to you. Nobody can take it from you. So that's the key thing to take away from that. So let's just go to the next one so that we'll be able to cover it. Sorry, how many minutes do I have? Okay, I think we have about 15.
15 minutes more.
15 minutes, thank you. So let's just run through it. So some of these other things, you see some of the quizzes. I put a lot there because that's actually the way for you to internalize what you're reading, because otherwise it can look like it's wordy, it's text-based. But when you look at some of those cases and analysis, it actually helps you, you know, understand what it is and how the questions may be phrased. So I'll just skip some of this because I've actually mentioned some of it. This is around the works that you've done, how it belongs to, you know, the employee. And then if another customer, if a customer of yours is going to actually compensate you other than what your employer is giving you, you need permission. But in this case, you might see examples that shows where it's a bit lenient, which means, oh, it can be reported after the fact, but that's because there's already an existing relationship. So let's go to the next standard. So here we are talking about, sorry, one moment. Okay, so here we're talking about investments, recommendation, and actions. So the first one is actually diligence and reasonable basis. That goes without saying. If you are going to say somebody should invest in something, you should have a reasonable basis for making that. And the only way you can do that is that you've done your research, you have documentation to actually support your decision. It's not that you just overheard somebody saying, you say, buy these shares. Why? You don't have any basis for it. So that's what the substandard 5A deals with. The next one is about communication. So it says you actually need to communicate to clients. You need to disclose to them the basic format and general principles of your investment process. They need to know how, you know, you decide what you decide. And another thing is that they need to be able to know the factors. You need to be able to communicate the factors, you know, that are important in the analysis. And another thing is that you need to actually disclose the limitation and risk. Don't, you know, in a bit to oversell, not say the risk that are involved. Like I'm sure all the other things you're doing in equity and portfolio management, you're covering all those very well, things around high risk, high return. And this other part is very important. You must distinguish between fact and opinion. Very, very key. A fact is different from, oh, this is what I think, and it must be there. And of course, things also around plagiarism, which would have discussed also in an earlier standard, is you must actually cite appropriately as, you know, need may be. So the next one is record retention. This one says you must develop and maintain appropriate records to support everything you're doing, from your analysis to your recommendation to your action. You must always have supporting documents. Now, this next sentence I want to say is very important. So it says, in the absence of regulatory guidance or firm policy, the CFA Institute recommends maintaining records for at least 7 years. But here, it actually differs to the firm to determine, you know, how long you keep those documents. So if the firm policy says 5 years, it should be 5 years that you go with. However, where the firm doesn't have a policy or the regulatory authority in that space doesn't really give, you know, a required guideline, then you go for what the CFA says, 7 years. So you can see that. Let's look at that last question just to highlight what I'm saying. So it says a member works for an investment firm. There are no applicable laws relating to record retention. The firm's policy requires staff to retain records for 5 years. whereas a local investment association recommends retaining records for 8 years. At a recent client briefing, some of the firm's largest clients expressed a preference for the firm to retain records for at least 10 years. To be concerned with the standard, record should be retained at what? You can see that there are differing opinions. The firm says 5, some associations say 8, some say 10. So here it's 5 years because the standard is referring to the firm's compliance. That is it. It's only where there are no firm compliance policy for record retention or applicable laws, then you refer to the CFAO, which is 7. So the next one is actually, conflicts. I've jumped. Conflicts of interest. So the first one, 6A, is disclosure of conflict. You must always disclose. You must make full and fair disclosure of all matters that could reasonably be expected to impair your independence and objectivity. So you just need to say that. And see, the next one shows how critical it is. It says it must be prominent, not that you're hiding it. You know the way we say, if you have an agreement to sign with any lawyer, make sure your lawyer reads the fine print. Here, we're not saying fine print. It should be prominent. It should be delivered in plain language and then communicate the relevant information effectively. So that is very key. The next one is priority of transactions. And that says that investment for clients and employers must have priority over investment for transactions in which the member or candidate is a beneficial owner. So it's saying you must do your client's transaction before your firm's transaction, before your own transaction. Now, there's a very common example that they use. That's, let's say your uncle is one of your clients as well, and your uncle is a regular fee-paying client like the other employees. So, I'm sorry, like the other customers, you must treat him the same. You must not say, oh, because you don't want them to think you are being partial to your uncle. No, your uncle is a regular fee-paying person. However, let's say that your uncle's account, you are also a beneficiary. That means you're a beneficial owner. Then it changes. But where it's just a regular fee-paying, then you must treat him with that priority, just like you would any other customer. The next one is around referral fees. This is still the same thing. So it's saying that it's still telling you that you need to be able to declare. If I'm saying, oh, use this service, and then I'll be paid for actually asking to use the service, I must declare so that you can then decide for yourself whether what I'm saying is just because of the money I'll be paid. So you must disclose to your, and in this case, it's both ways. It's not just to your client, even to your employer. You must disclose to your employer, your client, prospective client as appropriate, any compensation, the consideration of benefits received or paid to others for the recommendation of their service. Very, very important. I think I'll just skip some of these quizzes so that we can get to the last one and then talk a little about the global investment standard. So this one is interesting as it relates directly to you as participants also in the CFA program. So the first one, this actually relates to standard that guides the candidates and the CFA Institute members. So the first one says conduct as participants in the CFA Institute program. So it's saying members and candidates must not engage in any conduct that compromises the reputation or integrity of the institute, the designation, or the integrity and validity of any of the CFA Institute programs, which means highest ethical standards is what we're talking about here. For people writing exam, you can't cheat. When the proctor says time up, it's time up. So these are very, very key. The next one is reference to the CFA Institute, the CFA designation, and CFA program. So this actually guides how you use and what you say about being maybe a CFA charter holder or being a candidate in the program. So it says you must not misrepresent or exaggerate the meaning or implication of your membership or candidacy. So that, I try to extract something from there. Of course, if you say the exam is rigorous, that's understandable. You cannot say that, oh, I have a CFA level 2. No, I'm a CFA level 1 candidate. If you are not registered to take an exam, you can't say you're a candidate or you're not expecting your results. So those are some of the fine lines. You cannot say, oh, because you're a charter holder, then they should expect the superior results from you. No, you can't make such statement. Of course, you can always say things around self-exam is difficult. And then another key thing that is relevant to you is that you can't, share the exam questions or the broad areas that were tested, anywhere to people or online or social media. You can't do all those. Okay, I hope we all stay with me while we go to the last module of the ethics. Hello, can everyone hear me? I just want to be sure that we're together when we take the last.
Yes, we can hear you.
All right, thank you very much. So now we want to talk about the Global Investment Performance Standards. I didn't call them GIPS. I'm not sure that's what we should be calling them, but that's the abbreviation that seems to have stuck. And so here, I'll just go through the major highlights of this so that we keep to time. I think we have 5 more minutes. So the real thing that led to evolution of GIPS is actually because the Global Investment Performance Standard is because people can just do their reporting anyway. That makes it difficult to compare, performance report across several people. Even within a country, different people can, present their reports differently. So which makes comparability a bit of a hassle, which is why the standards were developed. And they are a practitioner-driven set of ethical principles that establish a standardized industry-wide approach for investment firms to follow in calculating and presenting their historical investment results, both to their clients and to prospective clients. There are 2 key things. This next thing I'm about to say is very important. So it says the GIPS standards ensure fair representation and full disclosure of investment performance. Always remember that fair representation and full disclosure of investment performance. The next thing is who can actually claim compliance. It's only the firm that manages actual assets that can choose to comply with the GIPS standards. It's not compulsory. Of course, you're encouraged to do it, but it's not that there's a law that says you must. So it's important that firm that manages actual assets, they are the ones that can choose to comply with the standards. Consultants cannot make the claim of compliance except they actually have assets that they manage. Neither can software companies. So that is very important. Always remember that. The next thing is that compliance is a firm-wide process. It cannot be achieved on a single product or composite. I cannot say, oh, this my product is the one that is compliant, or this my fund is what is compliant. No, it's on a firm-wide basis. The firm has only 2 options with regard to compliance with GIPS standard. The first is that you either fully comply with all. It's not that I comply with 2, remains 1. No, you must fully comply with all requirements of GIPS standards and claim compliance through the use of the GIPS compliance statement, or you don't comply with any of the requirements of the standard and you cannot claim compliance or make any reference to the standards. I think these things are also critical. It talks about the major sections of the GIPS. So the first one, fundamental of compliance, input data, calculation methodology, composite and pooled fund maintenance, etc. Now, this other part, I think I like to highlight them. So the key concept, one of the key concepts in GIPS standard is required use of composites. And a composite is an aggregation of one or more portfolios managed according to a similar investment mandate, objective, or strategy. This one is just to make sure that people are not just creating composite by like cherry picking, just picking the best performing one. This one, it means any portfolio, any fund that actually matches a particular objective or strategy should be consolidated into that composite. Now, this third line, please always remember it in GIPS, very important. A composite must include all actual fee-paying discretionary portfolio managed in accordance with the same investment mandate, objective, or strategy. Keywords, all actual fee-paying discretionary portfolios managed in accordance with the same investment mandate, objective, or strategy. Very important. The next thing is that the determination of portfolios to include in a composite should have been done ad initio. It's not that when you see the results, when you now decide where it will be, no. On an ex-ante basis, not after the fact. This is to ensure that it's not that you are choosing your best performing portfolios in a composite. Then the next thing, I want to repeat it again, is that a firm that claims compliance must include all fee-paying discretionary segregated accounts in at least one composite. Very, very important. And a firm must also include all fee-paying discretionary pool fund in any composite for which the pool fund meets the composite requirements. So when you're defining the firm, that's very important. You need to define it in the broadest possible way. I think we're almost running out of time. I think I'll just take 1 minute to conclude this slide. So this is very important. Then discretion too matters, because the way the firm defines discretion establishes the criteria to judge which portfolio will be in a particular composite. That means, are you the one that is making the decision about how that should be? The next thing is that you must not include non-discretionary portfolio in your composite. Very, very important. So that's why I put that last question there. According to the GIFT standard, a firm A must include non-discretionary portfolio in the firm's composites. B may refer to its performance calculation methodology as being in compliance with GIFT standard. May determine a portfolio is non-discretionary if clients impose restrictions interfere with implementation of the intended strategy. So you already know that here is C. You cannot include, non-discretionary one in there. So I think we're done. The other things that there are just some of the quizzes I put there to guide us. So it's just important to make sure that you do read the curriculum for ethics and the standards. You practice the questions. It has a lot of questions. You can even take a whole day to do it. And even if you have done it at the early stage of preparation, closer to the exam day, try to do it again. And then that's all I can say. I wish you the very best, in your exam. And we have faith in you, and have a good success. If there's any question, I'll take it now, so I don't overstay my time. And thank you for having me. Thank you.
Okay, I don't see any questions regarding
Okay.
this session in the chat.
Okay.
Thank you so much, everybody, for joining. Thank you to our facilitators, Mohammed, Buba, Bukola, Akele, Hassana Babangida, Umar, Abiola, Ahmed, Fola, Abimbola, and Abisola Akindolire, Mokpelola Jato, and finally Miss Adiola Gbadebo. We're so grateful to everybody. Thank you also to our sponsors, New Frontiers and First Quartile. We're really grateful. We would reach out to you guys via email with information, and then you can always go to our YouTube channels to catch up on all the sessions that were held today, because they are being streamed, so you can always use that to prepare if you have any questions. For the facilitators who are able to share their I see questions regarding fixed income. Unfortunately, the facilitator for fixed income was unavoidably absent, and therefore we could not hold this session, but we'll definitely communicate with you regarding that. The slides for these sessions, if the facilitator share, would put them together and send them to you via email, or at least in an email somewhere where you can access them. Thank you so much, everyone. We're really grateful once again. Thank you to all our facilitators, to our sponsors, New Frontiers and First Quartile. We appreciate you. Thanks to Society Office as well. Have a great day, everyone. Thank you.
Thank you. Thank you.